and I also learned how to become the bank. So I heard that on a podcast, and it just blew my mind. I was like, if this is real, this is insane. Like, so I started using becoming the bank with my real estate. And really, if you think about banks, they're experts at making money by leveraging ours, right? You put your money on deposit. What do? They take it and they lend it out to somebody else at a higher interest rate than what they're paying you. So they're just keeping the spread. That's what banks do. So if you can do that and have that fuel your real estate, you're making money in your real estate, but you're also making the spread like the bank does. So you're literally making money in two places at the same time with the same dollars. So it's like, that's incredible. I need to tell everybody. So I started telling everyone, mom, dad, aunts, uncles, brothers, sisters. Everyone's looking at me like I'm fucking crazy. And then I got on social media and it blew up. Everyone wanted to do it. So I just figured, hey, how about I just teach people how to do this and turn it into a business?
That's amazing. And let's dive in a little bit more into that. So, how do you become the bank?
So first, you have to just understand what banks do. What banks do is, again, they take in deposits and then they take those deposits and they lend them out. The reason why is because a deposit to the bank is a liability. So anyone that's followed Robert Kiyosaki, liability takes money out of your pocket, an asset puts money in your pocket, right? So to the bank, when you put money on deposit, that's a liability because they got to pay you interest, right? So all they do is they take that money and turn it into a loan, which is an asset because it's putting money in their pocket, right? So first, you just have to understand what they do. They get deposits, they lend them out, they keep the spread. So the way you become your own bank is you have an account that you have full control over that's guaranteed to compound and grow tax free. So you put money into that account, that's the deposits, just like banks. You're depositing money into an account that you control that's guaranteed to compound and grow tax free. Now you take it as a loan, just like banks do. You take it and you deploy it in a real estate deal. You lend it to someone else. You get that money back. Now you're doing exactly what the bank does. You're making an arbitrage on money and you're just using your money as the collateral to do so.
Got it. What's some common misconceptions when people hear this strategy that they're like, they just don't understand it? And is there a way for you to kind of demystify some of them?
Yeah, because the biggest thing is when I tell people what it is. So I said an account, right? The reason why I said that is because most people, once they hear what it is, they're like, it's a scam. It's life insurance. Most people think of life insurance as a death benefit, as something you got to pay for. You have a premium, but that's regular whole life insurance. What I do is I use overfunded whole life. So you have a small death benefit, so a small cost, and then you're just putting money on top of it. That money is guaranteed to compound and grow tax free because it's within the life insurance contract. But all the extra money you're putting in, you're overfunding, you instantly can use that money as cash value. So if you've got $100,000 in cash value, you can borrow against it. That means it's not going to stop growing because it's not moving from the policy. It's still in the policy growing. So now you just borrow against it. It's collateral to borrow from your future death benefit. Because think about this, dude. The insurance company knows you're going to die. So they'll let you borrow your future death benefit because they know that if you don't pay it back, they just don't have to pay it when you die. So you're in total control because you're borrowing something that's inevitably going to be paid out at some point. So you can pay it back and your family gets the full amount, or you can not pay it back and your family gets a little less. But if you don't pay it back, it should always be working for you to make you more money. So perfect example is I've got right now about $2 million from life insurance policies out working for me.
Yeah,
I'm
you want
not
to break
focused.
down what that looks like so people can have like a live example? You don't have to go into total detail, but just like, what does that look like?
So I put money into policies as premium. Again, I'm overfunding the policy so I can have cash value right away. So I've got about $2 million of cash value that I've borrowed from my future death benefit, and it's out making me money. So about 1.4 of it's making me 15%. So that means I'm making 15% on 1.4 million, which is like 18 grand a month, something like that. While it's still making money in the policy, 1.4 million is still compounding in the policy tax free at about 5 to 6%. So if you take a look at that, 1.4 million times 0.06, so it makes about $84,000, plus it's making me about $18,000 a month. It's the same money. I'm just borrowing my future death benefit. So let's say I died tomorrow. God forbid. My wife, actually my trust, would get the death benefit minus the 2 million because I have it out. I've already used it. See what I'm saying?
And then how much, real quick, how much did you personally have to fund into that to be able to have access to that 1.4?
I'd have to pull it up because that's over several years.
Right.
So like
but it's less, it's less than 1.4 million.
It's probably right about 1.4. Because
okay.
The way policies work is you have the death benefit, right? So you have a smaller death benefit. That's the cost. So that doesn't create any cash value early. It takes several years. The overfunding is what gets you the cash value. So let's say I put in like 100 grand into a policy. I'm not going to have access to all 100 right away. I might have access to 70, 80, 90 grand right away. But the next year, I put in another 100, I'm going to have access to more that year than I had the year before because it never stops growing. See what I'm saying? So I've got a policy that I'm about to fund. It's my 5th year in it. It's 125 grand. It's due July 2nd. So 125 grand goes in. It should go up by about 170. So think about that. I put in 125. I can immediately use 170. So what's that? 295, almost 300 grand working for me, but I only put in 125. I'm literally creating money out of thin air just like banks do.